would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. I hope you all enjoyed the replay of the Francis Greenberger interview yesterday. I did have quite a few of you who were kind of asking me about that show. I guess you came along after it was broadcast after it was uploaded. So I thought I'd go ahead and put that back up. It also fit in well with the fact that I am still fighting off whatever this bug is. It keeps coming and going. Yesterday was pretty bad. So it was nice to have a little bit of an opportunity to recuperate. Things are still going a little hinky, but I'm pushing through it. So in the spirit of pushing through, let's go ahead and jump in and talk about some interesting news items that are bouncing around today. We've got, I think I mentioned the Steve St. Angelo story last week or the week before. I'm not 100% sure I did. Usually I will take those articles and dump them, once I've shared them on the show. I did a quick search of my past shows, and I don't see that I did talk about it. So this may be the first time we're discussing this. Before we jump in, though, let me hit sort of the housekeeping stuff. If you'd like to get in contact with me, the best way to do that is through the website at therebelbroker.com. Man, I just, the brain is not firing on all cylinders today. Apologies. That's therebelbroker.com. Click contact in the menu bar and send along any ideas, suggestions, or observations that you might have. I'd be happy to hear them. Also, and this is a perfect time to bring this up, we have 2 more days till the end of the week. And if you would like to get a chance at winning a $50 Amazon gift card, I'm going to be doing the drawing for that this Friday at 5 p.m. Pacific time. So if you are hearing this and it is July 12th, then on July 14th, in 2 days, we're going to be going ahead and doing that drawing. And the way to enter is very simple. Go to therebelbroker.com, click the big red button at the top of the page titled Take the Survey to Support the Show. Give the same email address both times you're asked, answer a handful of demographic style questions. And not only will you be helping the show out, helping the show to grow, but you'll also be getting yourself in the drawing for that $50 Amazon gift card. Please make sure the email address you use is good. In other words, one that you will receive an email at, because 2 things will happen if you win. 1, I will notify you through that email address. And 2, when I send you the gift card from Amazon, it's going to be a virtual one. It's going to come to you at that email address. So I need that to work. So please make sure that that works. I've had only a couple of folks since we've been doing this give me email addresses that didn't lead anywhere. So obviously that didn't help. And just to let you all know, this has been going on for a while. I think we've given around $450, $500 out so far. We've been doing it once a month. And for all of you who've already entered, who entered months ago, you're still in the drawing. So just because it's a new month doesn't mean I throw away all the folks who are already in there. So for those of you who have been so kind as to already do this and who haven't won, you are absolutely still in the mix. So be patient. Hopefully, depending on how long I end up doing this, you'll win eventually, right? I mean, the odds are at some point. So good luck to everyone who has yet to enter, and congratulations to the folks who have already submitted their entry. Okay. It's looking like a little bit of a potpourri style day today. Normally I try to be at least focused on a general area and maybe have several stories that all sort of feed into it or link together. Today did end up being one of those days, but we've got a few interesting takes. And I think what we'll do is we'll go ahead and start with the stuff I mentioned a moment ago relating to folks out there in the world who are trying to look in the crystal ball and give us an idea of what's coming. Now, I have been spending more time sort of laying out facts than offering specific things that I think are going to happen. I mean, I've mentioned, I've theorized, and I've told you things I'm doing, and I've told you about my feelings in terms of what's going to be going on with the marketplace. I don't think what's going on is sustainable. And apparently there's a lot of other folks who also share that opinion. Now, the first one we're gonna sort of just brush by here is from Steve St. Angelo. And he was speaking on the Peak Prosperity podcast, where he said, prepare for an asset price decline of 50 to 75%. He says, when the debt bubble pops, it's taking everything with it. And I don't want to do the whole confirmation bias thing, right? We tend to be drawn to things that tend to confirm what we think is going to happen. So I would suggest that you evaluate this for yourself. Maybe go check out their podcast. There will be a link to this in the show notes for today's show. So feel free to check that out for yourself. I think it's amazing that they're talking about numbers in the 50 to 75% range. Simply because, for the most part, that is more than what we saw last time. Now, in some ways, I hear that and I don't immediately think, well, that's crazy, right? That's insane. We saw areas where home prices dropped as much as 50% in some of the hardest hit areas here. 30% was, I think, pretty typical in a lot of the areas around here. 20 to 25% in some other areas. Why would we expect a greater decrease in asset value this time around? We've talked about this before, but to really summarize it, it's because the bottom line is we are not as in robust an economy as we were last time when we were sort of at the same point. Now, if we're assuming that we are a year or 2 years away from a downturn, and I think that's a pretty reasonable amount of time to ascribe. That's one reason why I'm in the process of selling my home and planning to not buy another home in this market. I believe in these numbers enough that I'm throwing my own assets into this. Things just aren't as robust in 2017 as they were in, say, 2005, leading up to the downturn. Last time, you could point to really goofy practices, but in general, the economy was kind of okay, at least in a broader sense. This time around, it is not. A lot of people tout the unemployment rate that we have right now, or the employment rate that we have, and the reality is that we may have officially on paper that kind of employment, but we also have the lowest participation rates in history. So there's still an awful lot of people out there who aren't working who could be, and they count, right? They, even folks who aren't counted in the statistics are out there involved in the economy as folks who consume things and do things, right? Spending money, living in someone else's house, however they're making ends meet. Those folks still exist. They're still a contributing piece of the economy. Whether it's a positive or a negative contribution it will depend person to person, but they're still in it, right? They're still in the mix. The other problem is there's just such widespread problems. We have things throughout different economic areas that are bad. Now, we've already talked about all the things we're doing in real estate that are a concern. We've also got stuff relating to auto loans. We have things relating to HELOCs, which is also still related to homes, of course. But then we also have student loans. There's a lot of things. And a lot of these things weren't really issues last time. We've got pensions that are really bumping up against the wall of death for them, where we already have Illinois, who the way things are right now, 100% of the taxes they collect go to paying pension benefits. So for those of you who didn't hear my show on pensions, in terms of the contribution they would make to a relatively high-risk market for real estate investing, you might want to go back to the site, therebelbroker.com, and check that out. But kind of the short version is Illinois is in that situation, which means once they've paid their pension stuff, they have no more money for anything. No more money to pay any city employees, no firemen, no police, no doctors, no nothing, no teachers, nobody. So everything else is just having to be gotten in some other way or going into debt. And when we talk about going into debt, we can talk about how that's also linked to the stock market. Now, the stock market, the last time I looked, was up at around 21,000. Google that. Google how healthy is the stock market. And you are going to find nobody thinks the stock market should be trading at 21,000. Almost nobody. It seems like a accepted truth that the stock market is overvalued. And a lot of that has to do with the Fed sort of propping it up. The way they've been working with rates has often been specifically aimed at shoring up the stock market. But if the stock market takes a dump, that pushes over pensions, because the money that pensions do have are all in the stock market. So all of this stuff is connected. And when one thing goes boom, it potentially drags all of it down. Because remember, whether you want to believe it or not, car loans are in fact linked to the stock market. Car loans get bundled together and securitized just like old mortgages did. And in addition to that, the key element of a car loan is the person who holds the loan, the person who owes the money and is making the payments. And if other parts of their life are negatively affected and their income goes down, then they start making choices about what they're not going to pay. And that ends up affecting other things like car payments. We've already seen a large level of default with 2015 car loans that were securitized. And these are all crazy things, right? And we've talked about this before, so I'm not going to totally rehash that whole thing. But suffice it to say that there are far more points of failure now than there were last time, at least in my estimation. Maybe I'm far more paranoid about it now, so I'm noticing more. I was definitely sort of worried about loans and how easy money was to get from about 2003 all the way up until 2005, but I didn't become a really strong follower of every tidbit of news until after 2006. So maybe it was as bad then, but in going back and reading things from them, it sure didn't seem like it. Everything felt a lot more robust. Now, let's go ahead and cover what Mr. St. Angelo has to say. Now, I did a quick Google on him, and I can't find anything that points out that he's nuts, because every once in a while you'll find these guys that seem to earn their bread and butter just on pushing everything's going to explode sort of dialogue about the economy. So let me just there's an excerpt here from the podcast. Let me just read it to you. And of course, as I mentioned, there will be a link in the show notes to this so you can check it out for yourself. And let's see, he states, what we have is a totally propped up market based on debt. Energy isn't producing positive growth, really. So instead of having real economic growth, we have inflated economic growth and inflated asset values. Houses obviously being in that. And we're going to talk specifically about houses here in a second, because you could argue, well, he's talking about assets, not necessarily homes. However, let's move on and hear what else he has to say. He goes on to say, as the energy return on investment started to fall for the United States in the 1970s, we had to start offshoring our manufacturing as a way to extend the U.S. lifestyle. We couldn't afford the manufacturing anymore because of our oil energy return on investment. It moved over to other parts of the world where labor was cheaper, and we started buying more homes, more things, more stuff, and we went into debt to do that. That has extended the leech and spend U.S. suburban economy. If you look at it on face value, it looks like this is continuing. People are moving around, buying stuff. A lot of people are traveling, but it is all based on a lot of debt. When the debt finally implodes, the really nasty face of this whole fraud will be shown to all Americans. I don't think many people are prepared for it. Now, just to kind of step out of what he's talking about, there's one more paragraph I want to cover because that's where the really sexy stuff is. But that also sounds a lot like 2007, doesn't it? When everything went nuts. And what's interesting is to do as I've suggested and pay attention to what people do when they are confronted with debt they cannot manage. Because I would argue that people are going to make the same decisions regardless of where the debt failure occurs, right? Last time it was with housing specific related things. This time it could come from anywhere, but the bottom line is folks look at their overall debt and then respond to that in ways that make the most sense. Now, their committedness to mortgages and their mortgage on their home and all these other things hasn't changed, the level of commitment. In fact, if anything, it's been undermined because people have learned that you can simply not pay your mortgage for a really long time and stay in your house. So I think the same kinds of decisions would get made again, which would indicate that we would see a dramatic impact in the real estate world. Okay, so let's go on. because this is the sexy part. So if you've been napping up until now, if you've been napping for the last 15 minutes, this is the time to wake up. All right. When growth starts to decline, I think we're going to see the valuation of assets decline considerably. It's anyone's guess how quickly they can fall, but according to what I've been looking at, I think we're going to see a 50% decrease in real estate values right off the bat. I'm not saying this will happen in a day, but the first wave will be a 30 to 50% decrease in real estate values when the markets really start to crack. They are already at the edge of the cliff, and I see prices falling down the cliff, struggling to recover, and then falling even further. Actually, I predict within the next 5 to 10 years, we can easily see a 75% or more reduction in real estate values. What does that mean for stocks and bonds? The same thing. If we start going into more rapid disintegration, you're going to see the valuations of stocks, bonds, and real estate really decline much greater than anybody has any idea. All right, so he's got a timeline here that he's giving us of 5 to 10 years. I would guess that timeline is a little shorter than that. I would think we would start to see the cracks in what's going on within 2 years. I've even read one guy who is looking for something to happen this October. And I got to tell you, I actually kind of share that opinion. I think if something's going to go nuts this year, it's going to go nuts in October, which is one reason why I'd kind of like to get out of my property by October, by the middle of October. And I'm on par to do that. That's my new date. For those of you who've been listening for a while, you know my original plan was to sell in May, June. And now that's moved forward based on some contractor issues that I was having. But as long as I can make it before October, and I am very confident that I can at least do that, my feeling is I'll probably be able to go on the market before the end of July, but we'll see how that goes. I can get that completed and be out and be renting and move that money into other investments and other marketplaces that are likely to be less impacted. But anyway, that's just sort of an update on my side thing. But why do I think something nuts is going to happen in October? Well, to sort of get us all started, let me suggest you load up Google and do a search on stock market October 2017. And what you will be greeted with is an awful lot of articles from an awful lot of reliable sources, whether you want to talk about Wall Street Examiner, Wall Street Journal, Motley Fool, Reuters, Market Watch. These are all sources that tend to be pretty reliable, ones that a lot of us rely on. And just a couple of them that I'll include links to in the show notes. The headline from CNBC, expect a market correction for the S&P 500 this October, according to technical analysts. And another one from Seeking Alpha, expect a 10 to 15% decline in the stock market. Now, we'll discuss this a little bit more, but right now we're going to take a quick break, so don't go away. Will we be seeing a big drop in October of 2017? Well, we'll chat about that a little more in just a minute. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We are chatting about what to expect from the real estate market, and I threw out the probability or the idea that we would see something that could kick a lot of bad things off this October. Now, I realize this is probably one of the most firm, or not firm, but most specific crystal ball moments in the show for a while. A year ago, I was really willing to say this is what's going to happen next season and whatnot. So many different things have been going on. It's been much more difficult to estimate. But I think that this is a reasonable expectation. And one reason why it's reasonable is because it tends to get repeated a lot in the past. I have no idea what the deal is with October. I'm sure there is some deep, involved, very pedantic explanation for why October tends to screw with the stock market, but it does. Now, according to the technical data, they're talking about potential head and shoulders forming, and that is a thing relating to the graph of the market, where you see a head and shoulders, meaning you get this peak. It kind of stays for a little while. That's the one shoulder that then becomes a head. And at the top, it starts to decline a little bit. And the expectation is it'll drop to about the same level it was, quote unquote, the neckline. And then it'll move on and create the other shoulder on the other side and then go down more, right? So there's the target point, there's the neckline, there's the potential head and shoulders, all that kind of stuff. So I'll include a link to Pinterest, or I won't include a link to Pinterest. There's a link in Pinterest at the site. Go to Pinterest, and you'll be able to see on my Pinterest page, there'll be a graphic that kind of shows this with little blue words describing where the head and shoulders thing lives. And in the past, if you look back at what's happened to the stock market in the past, October seems to be that magic month. Now, investors can expect, according to this article from Seeking Alpha, a 10 to 15% decline with a possibility of a 20% decline. And they go down sort of a little bit of what all that is. But what would happen? Now, we talked about this as it relates to pensions, right? That's why I was mentioning pensions before the break. If we see that kind of a big decline, I've already sort of laid out what those dominoes could look like. Stock market drops, pensions get their problems accelerated, which makes Illinois absolutely a pit of debt. And other states that maybe are right on the edge or getting very close to Illinois' situation are suddenly accelerated into that position. And then suddenly we see a need for a solution, and a need for a solution right now. And what happens? They appeal to the federal government. These other things folks are talking about with other states taking over chunks of Illinois is actually absolutely idiotic. Nobody's going to do that. But the federal government will print money. And the difference this time is that money that gets printed will go directly into the hands of folks out in the populace. It won't go to banks. So what you'll end up with is money with velocity. And we talked about velocity in money before. The money we got before in the real estate downturn didn't have velocity. It went to banks who then gave it to other banks, right? It was just sort of went from one place to another. It was used for buying properties. So you never actually got that money. It was money that went from one bank to another, or one holding company to another, or to the government, back to the government, right? In terms of getting held by FHA or Fannie or Freddie, securitized, whatever, all those magical things. None of those things equal money in your hands. So that means it doesn't have velocity. Money with velocity is money that gets made and goes right into the hands of people. It was never real dollars. It was digital dollars. It was just in a computer. You start solving pension problems with printed money, and that goes straight into the hands of people in the real world, and they start spending it, and that's when we get crazy inflation. So by not having a great deal of velocity last time, inflation didn't go as crazy as it could have, but it would be much higher here. And my contention would be that set of circumstances would absolutely be a probable thing to start to push this ball to the tipping point where it's just going to roll right down that hill and squish everybody down there at the bottom. So kind of keep that in mind as we're going through these things. Another article, yeah, so there's two articles. I'll include both of them so you can sort of noodle through and decide whether or not you think something's going to happen in October. I don't think there's any question. I think something is going to there's going to be a negative event as it relates to the stock market in October. The question is, what will be the scope? How far will it go? And then if it does do 20%, if this guy's highest estimate is right and it does 20%, I think that's a huge deal. And I think it potentially starts the process of decline. And we can see how that goes. Remember, this would be a first step in a longer process. I don't think this happens on a Monday and then Tuesday we're all in deep trouble. but I think it slowly leads up to it, and could ultimately end up in a lot of very creepy things, particularly if inflation does end up kicking up after the government, because the government would have to take action, the money would have to get distributed, the agreements would have to be made. So it could just be that first domino that starts a 6-month to a year process. But keep an eye out for it. I think it'll be interesting to watch that unfold. All right, so we already talked about Steve St. Angelo. Again, going to include a link to that page so you can check it out for yourself. The latest person to chime in terms of what they think is going to happen is Mark Yusko. And just to give you a little bit of background, Mark Yusko is an American investor, hedge fund manager, philanthropist. He's the founder and chief investment officer and managing director of Morgan Creek Capital Management, which is an investment management firm that advises pension funds. Yeah, see there? Endowments and wealthy individuals. Yusko is a proponent of the endowment model of investing, which favors diversified strategies by asset class, yada, yada, yada. Okay. Why did I repeat pension funds so many times? Well, you should know why I repeated it so many times. This is a guy who is someone who gives advice to pension funds. He helps them figure out where to put their money. So this guy knows pension funds. He's very well respected. This guy is not a nut. He is not a bomb thrower. He is not someone, in my assessment, I've read some of his stuff. He's a very level-headed dude. He got a Bachelor of Science with honors in biology and chemistry from the University of Notre Dame. He went to get a master's of business administration and accounting and finance from the University of Chicago. Not a fly-by-night guy. Right? Go read some of his stuff. You can go. There's a link. I've got a link to his Wikipedia page. So feel free to check that out and see what you think. But he's got some very interesting things to say. Now, he had a May keynote where he said, quote, "I'm telling you right now, the U.S. is going to have a crash and it will be massive," noting that efforts to generate growth through fiscal stimulus and tax cuts will prove futile because the working age population in the U.S. is declining. As such, consumption, which makes up 70% of the U.S., will continue to fall. Adding that, quote, "Every time a president leaves the White House after two terms, there is a recession within the first year of the new administration. I believe this time will be no different." That is a mind blower. The fact that he makes that statement, and you know what? It's not wrong. You could talk about it being serendipity, that things just happen that way. But again, it kind of fits in well with this idea that we may see something come October. Yusko warns of similarities in the current period to the buildup of the Great Depression and warning that this fall is when things will come to a head. This fall, October. Yusko told CNBC on Monday that he believes too much stimulus and quantitative easing has resulted in a huge bubble in U.S. stocks. Now, we've been talking about this, and that's one reason why I think that 20% potential estimated drop in the stock market is totally reasonable and could actually be a low number, even though they're selling it as the high number. It may simply be that it hits 20% and stays there for a little while and then continues to go down. My feeling, though, is that it needs to go down. I think it'll drop down to 25% in relatively short order. Yusko, let's see, quote, "I have this belief that we're flowing toward the path of 1928-29 when Hoover was president. Now," continuing, he says, "now Trump is president. Both were presidents with no experience who come in with a Congress that is all Republican, lots of big promises, lots of things that don't happen. And the fall is when people realize, wait, it hasn't played out the way we thought. By the fall, we will have a lot more evidence of declining growth. Growth has been slipping," he said. So this is all scary stuff. It kind of sets the stage. And if we were looking at a reasonable timeline, right, we try to walk away from this information with some sort of an idea in our head on what can we expect? What is the thing we think will happen based on this information? Well, I believe that we are going to see the start of whatever is going to happen in October. We may get a period of time after October where people try to stay confident. Maybe the real estate market doesn't take a huge dump immediately after that. But as the effects of a downturn in the stock market trickle through, it wouldn't surprise me one bit if we start to see things hitting the real estate world based on other things that are going on, whether it's people stepping more away from debt, making decisions that maybe have them not paying for things. But this is all going to be very interesting to sort of watch unfold. Now, one other thing to warn you about, if we do see the stock market start to take a dump in October, what would the Fed do? Now, we saw the Fed being willing to leave interest rates very, very low for a very long time in order to prop up the stock market. So the Fed may actually, from a political standpoint, I don't think they can do this. I think it's one of those, we have to do things to indicate confidence in the system. But it wouldn't be unreasonable to entertain the idea that the Fed would actually back off of recent interest rate hikes. I don't think that would be smart. Unfortunately, I think a painful thing has to happen for this situation to sort of resolve itself. But when have you ever met anyone political or financial who's willing to take the hit to start the healing process so things can get better? According to this last bit, he also sees trends that are going to push interest rates down, making growth harder to find and emerging markets more attractive. Those trends are the killer D's, according to USCO: bad demographics in the U.S., Europe, and Japan, and too much debt and deflation. All right, so that sort of is the umbrella of the latest information relating to what's happening with what I think is trying to make the call, trying to anticipate the potential downturn in the market, and is one reason why I'm changing my strategies to sort of match that. Some other interesting data that is out there that, again, sort of bolsters what we've been talking about here is that average FICO score reaches 700 for the first time ever. We were talking about this a while ago in terms of, I think the number we had talked about was 695 or 690 for the first time it had gotten up to that height. Not ever, but gotten up to that point. 700 now is considered very good credit. More consumers will likely qualify for the credit they want at favorable terms. I want you to ask yourself, do you believe that increase in FICO scores has anything to do with any real changes in the way people have been doing things? Remember, these are all changes. The only time these changes that have been noteworthy have been in the last quarter. A lot of folks are talking about how credit scores bottomed out at 686 after the housing crisis with the foreclosures and those types of things, and that's all absolutely true. And they try to imply that this is something that's been steadily increasing. This is not a steady increase. This is kind of a big jump, and it's because of all the things we've talked about here, where credit scores are artificially being boosted. It's impossible to not see those two things correlating, and why they talk about this in a way that seems to imply that it's organic. This article, amazingly, from Housing Wire, doesn't make mention of any of the things we've talked about in terms of relaxing of credit score stuff or how credit scores have been artificially increased. They just talk about the Urban Institute showing the new FICO score for originations increasing. While credit standards remain tight, a new Fannie Mae survey shows the majority of lenders expect to loosen credit within the next few months. And they don't make any mention of this other stuff. They do go ahead to say, even as credit loosens, two major changes could make getting a mortgage easier for millions of Americans, continue boosting FICO scores. So what's funny is they talk about the access to this money boosting FICO scores rather than the boosting of FICO scores facilitating the borrowing of more money, which is the more accurate way to refer to this. The other little tidbit, homeowners get better at predicting home prices for first time in months. This is a huge change. You as a buyer out there have been contending with this idea where sellers are expecting their homes to be worth more than they're appraising for. So that absolutely feeds into bloated listing prices and perhaps sellers who are not willing to take more reasonable offers, which tends to push buyers into a position where they're not only expected to pay what is not a reasonable amount for the home, but pay even more because they're in competition with these other buyers. And then once the purchase is made or the contract is signed for this bloated amount, the house then does not appraise. And the seller simply says, well, you're going to have to come up with more cash if you want to buy that house. That's a very untenable situation for an awful lot of buyers in different marketplaces. I'm going to suggest, and I realize this is tough. I realize there are buyers out there who are just buying for themselves, who are tired of looking. I have some buyers that have been looking for 9 months and just feel like they're constantly getting squeezed out of the marketplace. Unfortunately, their options are a little bit more limited, and they've got some other limiting factors that keep them from being able to move as quickly on some of these. But as someone trying to give advice to a buyer, and while I understand the frenzy that can occur, try to resist the frenzy. Try not to participate in the frenzy. Maybe try to come up with more options for you in terms of how you can maybe search in a marketplace that'll satisfy your needs, maybe increase your commute, but reduce that competition level so you're not up there going crazy. Because the reality is, and there was a time when I had listings on homes and I knew the house wouldn't appraise for what we were going to sell it for. And I would tell agents before they submitted an offer, you need to be prepared for this home to not appraise. And are some of these appraisals too low for bad reasons? Yes. Sometimes there are simply no comparables. With the ridiculously low inventory we have right now, finding comparables is very, very difficult. They have to keep widening the circle in terms of what they're searching for, and oftentimes that equals including properties that may be the same in terms of square footage and amenities, but are not in a similarly desirable neighborhood, so it can tend to drag down those prices. How do you combat that as a buyer or seller? You make sure that the appraiser has all the information available that your agent would have provided. Your agent should be there for the appraisal to make sure the appraiser knows those market things that appraiser may not be aware of. But you also, as a buyer, need to be prepared for that mentally, or at least up till now. While home values have jumped more than 5%, so it actually may be a situation of home prices just finally reaching what sellers expected. At least now, you can expect in most markets that homeowners were at least within 1.7%. Now, homeowners estimated their homes are worth 1.7% more than the appraisal estimate, so at least it's closer than it was. Now, it's one of the first things that folks really need to be aware of because it's one of the first things that could occur. Once you have gotten into a contract and you've told your lender, they usually send the appraiser out within the first 10 to 15 days. So be prepared for that mentally, that there may be some sort of a discrepancy there. And if you're in a competitive market like mine, it's happening pretty frequently. However, at least now there are, with some recent sales, there are enough comparables that in some markets, it's not as difficult to track that stuff down. Finally, on today's show, I wanted to hit one more article that I thought was funny because we've talked about this a few times. The headline is Building Larger Homes, Trend or Trouble? So remember all the headlines. We were all supposed to be buying into this idea that what millennials really wanted were micro homes. Micro homes were the solution. All these kind of offbeat things. And there was this huge difference between buyers of 10 years ago and buyers of today. And what's the reality? No, there is no difference. People continue to want to get as much house as they can for their money. If they have to settle for smaller, they will. It's just like people will live in an apartment before they'll buy a home because they can't buy a home. Folks will buy a smaller home because they can't afford a bigger home. It has nothing to do with desire. It has to do with need and satisfying basic needs. So this idea that builders are building larger homes and they're selling should not surprise anyone. I don't find folks who prefer a smaller home. Have I seen? Sure, there are absolutely situations where, you know, if someone could find a 6-bedroom home that was the same price as a 4-bedroom home, would they buy the 6-bedroom home instead? Well, they might not, right? It's so large, keeping it clean would be a pain in the butt, so they don't want to do that. However, I'd kind of argue that most folks probably would. If I could find a 6-bedroom home for the same price as a 4-bedroom and it was in the same general neighborhood, I'd be all over that. I'd be going in there and doing some remodeling and turning that into an in-law quarters, a 2-bedroom in-law quarters with its own entrance and its own kitchen, and then I'd be renting that bad boy out. So even that doesn't really hold any water. So I don't know why these guys are surprised. It just amazes me, and maybe that's just the market I'm in. But I have not seen anybody saying, "Gosh, you know, I'd really love to buy that 4-bedroom house that's 2,300 square feet. But you know what? I just feel like I want that 4-bedroom house that's 1,300 square feet because that's more me. I just never hear that. It's just not a reality. So anyway. All right, folks. Thanks again for listening. I truly hope that with each and every show, I am giving you far more valuable information for you to ponder than the amount of time it takes for you to invest in listening to the show. It's always my goal to give more than you're having to invest, and hope that that's been true today. Thanks again for listening, everybody. I'll talk to y'all next time.